Let's bring in now Brian Levitt, Invesco Global Market Strategist, to talk about the market action on the day. Good to see you, Brian. You saw the notes there from Jared. Emily mentioned the jobless claims, lowest since 1969. Chip stocks leading the way. What are your broad takeaways from the day's action?
Well, I mean, clearly it is a very strong labor market. It's a very strong economy. And so, investors have been grappling with this strong economy versus a heightened inflation policy tightening environment. What I view from the market over the last, call it even today, is that what we're likely to see over the course of this year is a slowdown in economic activity from a very robust level amid policy tightening, which will tighten financial conditions, is already flattening the yield curve, tends to favor structurally advantaged businesses. And so you're starting to see, particularly within the NASDAQ, at least for one day, some of those names starting to recover a bit. They had been left for dead amid concerns about ever higher inflation and higher rates, but tightening financial conditions should favor structurally advantaged growth businesses.
And Brian, as we look in those tea leaves, the T standing for U.S. Treasury yields, obviously that is a forward indicator of potential economic woes of a recession. What are you keeping an eye on in that space? And how far out do you think we might be from a recession if it happens?
Yeah, so you want to look at obviously we're all focusing on the spread between the 2-year and the 10-year Treasury, which has gotten to about 20 basis points. So it's telling us something. What's it's telling us? It's what we already know. Inflation is too hot, so short rates are up, but growth is likely to slow amid tightening. So long rates are up, but not nearly as much as short rates. What you typically find, and remember, we're not yet inverted, what you typically find is that from the first minute of inversion, it usually is about 18 months until you have a recession. And markets actually tend to do, or at least historically have done very well from early inversion to the peak in the market. In 88, we were up over 30%. In 98, we were up over 30%, at least 88, 98 through the end of that cycle, we were up over 30%. So I think a lot of investors try to use a flattening of the yield curve or even an inversion of the yield curve as a timing tool. It's not a great timing tool for equity investors. It is a harbinger of future economic woes, however.
You mentioned that we're likely to see a slowdown in economic growth this year. Of course, we have the Fed now moving towards tightening. How would you suggest that investors be positioned against this backdrop?
Yeah, so in a slowdown, you still want to favor equities. Equities still perform well in a slowdown. You want to shift towards higher quality, lower volatility, dividend-oriented, structurally advantaged growth businesses. It's the recovery where you want to go lower rated, really cyclical, deep value, lower rated parts of the market. Expansion's kind of a rising tide that lifts all boats like we saw last year. Slow down, shift towards higher quality, bring that risk profile of the portfolio back towards neutral. But importantly, don't flee the markets. I think investors are very thinking of this in a binary way. I'm either in or I'm out. Slowdown means you just want to bring the risk profile of the portfolio down, but still favor equities over most other asset classes.
Do you think an inverted yield curve is inevitable at this point?
I do. The forward curve suggests that we will see an inverted yield curve, maybe even in the second quarter of this year. That's the 2-10 spread. Now, of course, the Fed funds rate is exceedingly lower, significantly lower than the 2-year Treasury. So that tells us a couple of things. One, it tells us that the Fed is behind the curve, and it means that the Fed is going to do a significant amount of tightening this year. But in actuality, the spread between the Fed funds rate and the 10-year rate has actually steepened over the last days. So if the Fed is as behind the curve as we think they are, we probably want to focus more on the spread between the Fed funds in 3-month and the 10-year than the 2s, 10s, because it's the Fed that will ultimately end this cycle. And if they have to continue to tighten until the economy can no longer stand it, that will be the recession. So yeah, 2-10s gives us information, ignore it at your peril. But the Fed's behind that, and so it probably extends the cycle.
And I want to ask you about retail investors who we did see obviously buying the dip and then another dip and then another dip. How should they be positioning themselves and really trying to make sense of what they might be seeing in the short to midterm?
Yeah, I mean, I think retail investors tend to touch the money too often. We know they're in, they're out, they're shifting. I mean, I always advise people have a plan, stick to it, and invest with courage over the long term, and recognize that every generation faces challenges, but over the long term, the market will reflect whether things are getting better or worse. And I think those of us who are investing have to believe the world's going to get better over time. And so, what I would say to investors here is, make sure you have some diversification. You want a more balanced, neutral approach to investing. So you don't want to be speculating in markets. You don't want to be taking excessive risk. You don't want to be speculating on businesses that don't have visible earnings. You want a more higher quality, more balanced approach to investing than what was required in 2021.
When it comes to inflation, we saw tentative signs of a leveling off in the latest PPI data, certainly not in the CPI data. How are you thinking about when we get to that peak in the broad inflation data and potentially get a deceleration? And do you think that can be achieved even in absence of aggressive Fed tightening?
So we were going to get there, middle part of this year. In fact, if you look at the retail inventory to sales ratio, it was starting to widen. And that's because the American consumer is saying, I don't really want to pay these prices anymore. And that was giving businesses an opportunity to rebuild inventory. The challenge is now that, given what's going on in Eastern Europe between Russia and Ukraine, is that we're seeing commodity prices up significantly, and there's going to be a whole host of supply chain challenges that persist. So inflation is going to be with us longer than we had hoped. And so the Federal Reserve is going to be full bore with regards to tightening. Now, the challenge is the Fed can't solve supply chain problems, but they're certainly going to work to slow demand. I do think inflationary pressures will start to come down later in this year into next year, because the more we spend all this money at the gas pump or at the grocery store, the less we want to spend on other discretionary items or on services. And so at some point, the solution to these higher prices is higher prices. Inflation will start to moderate. That'll be a good sign for markets, but it may be a bit of time before we get there.
All right. Well, we do appreciate your insights today. Brian Levitt there, Invesco's global market strategist. Thank you for your time.